So as we turn to the European markets, it's important to look at where things sit right now and the pressure that continues. So when you look at consumer confidence, it's still negative 17.8, very consistent from August into September. When you look at economic confidence, slightly better, kind of in line with where it was previously. Industrial confidence, improved slightly, but still negative. But the CPI side, so estimates came in at expected at 4.5, came in at 4.3 for September. CPI month on month came in at 0.3. So again, you saw things a bit better, but it's still positive. Like month on month, yeah, it wasn't 0.5, but it was still 0.3. It was still a positive contribution. And now you have natural gas to contend with. You have some of these underlying issues as we go into the winter months. Now, who knows? I don't pretend to be a weatherman. I don't want to be. But if we have a normal to cold winter, we're going to have that stress that we continue to expect and see really start to come up in with vengeance. On the manufacturing side, you can see that the expectation was for 43.4, came in at 43.4. So again, still very sluggish. Eurozone services expected at 48.4, came in at 48.7. Still like kind of sitting in that contraction, putting the composite at 47.2. That is not a good situation when you think about that underlying growth. And again, confirms that we're very steeply in a recessionary backdrop. It's not, it wasn't that, the Eurozone service expectations were 48.4 and it came in at 42. It was 48.7. Eurozone composite PMI. It was expected at 47.1, came in at 47.2. It's not that we're getting a collapse. And that's when people hear recession, they think of, oh my God, the growth is going to be so negative. It's like, no, it can be negative, but not dire. And that's what we continue to see given the amount of liquidity in the market, the amount of pressure in the market on the debt side, but still there's the liquidity is still out there. It's still sloshing around. Retail sales expected to be down 0.5, came in down 1.2%. Year on year came in down 2.1%. So again, you saw that reduction that we've been talking about, but on a PPI side, expectation was for 0.6, came in at 0.6, but previously was at negative 0.5. So the reacceleration happened in August on the PPI side. It continued in September into August, into September, which again is why we see CPI actually reaccelerating and becoming a much bigger problem. This, I think, was a good chart from IIF that just shows all of the PMIs, the PMI orders minus inventories, how when you look at Germany, Austria, Czech, France, Poland, Netherlands, Spain, Italy, they're all in contraction. They've stopped going down, but it's just what we've been saying is we're going to kind of flatline here, and this is why we see more pain, more of that GDP negative moves, and this kind of shows, I think, very, very nicely why we believe that they're in a very steep, I say not a steep recession, but in a recession to right now. We don't see we don't see much falling from here, which is why we've been saying it's like, look, it's going to get to a point, it's going to be a fast drop, and then it's going to flatline, and that's going to take time to have things weed out. The problem is, and this is interesting, of what is the next shoe to drop, then the non-financial private debt as a percent of GDP. Switzerland, Sweden, Netherlands, France. The next shoe to drop, in our opinion, is Italy. So Italy, this is non-financial private debt. Looks okay, but it's the debt to GDP level. And the problem that you're seeing is they're the next one that doesn't have the collateral. So Japan, as you can see here, as you can see with what the BOJ is trying to do, they're trying to backstop things and they're losing control. And when that finally gives way and rates spike and the yen finally drops, Italy is the one that is kind of screaming a flashing light as the next problem. So that is one piece. Then you have the housing side with the negative amortization, the ARM adjustments, which is impacting things much more in the financial space. This just puts into perspective the Eurozone manufacturing PMI, where it has fallen, and then the industrial production and how there's really not much to pivot things higher, which is why we do continue to see that pressure point and those issues remaining. Eurozone service PMI, incoming new business. This is the bigger concern of why we don't see it improving. And again, it's incoming new business. How are things going to look when you look from September into October, November? And you can see they're sluggish. There's not much to say in terms of an excitement, which is why we see this pressure continuing well through Q4. Eurozone retail sales rolled over. Eurozone excess savings versus deposits, continue to go, inverse. But the Eurozone retail sales is that big drop. Retail sales declined further, showing a negative carryover in Q3 with consumers drawing down their excess savings, moving from overnight to term deposits amid higher interest rates, and should be less supportive to consumer spending going forward. And that's what we've been saying is like the consumer is the last shoe to drop. And we saw it with ASCN orders, that all of a sudden had a big drop. And it's because you've seen retail sale inventories build, less orders driving that down. And it's because retail sales are seeing the bigger drop. And that's that last piece, which is the service front, which we've been talking is the biggest concern. Italy government debt, we wanted to look at the 30-year, and this just kind of puts into perspective the risk. And this is interesting, is that rate of change. You could see on how it's had a very big move up. And it may not look as extreme because you're like, well, 5 to 5 3/4. It's like, but that's big when you think of it on a bond level, and that pressure isn't going anywhere. And when you think about the ECB that's now stuck, and this is what we've been talking about, and people are going to say, oh, well, they're poor policy now. The poor policy in their eyes now is because of poor policy previously. Because they kept everything so loose for so long, they have no choice but to keep it tighter than they want. So everyone's like, oh, they should be cutting, they should have better policy. And okay, you're not wrong. Now is when you should be cutting rates, but that's why you shouldn't have had negative rates for the last 10 years, because now you need something, but you utilized it at all. All of it's been utilized. All of that liquidity, all of that benefit was to make good numbers better. So now when you have bad data, you have problems, you have no support because you blasted it everywhere for no reason. And that's why people who are saying now's the bad policy are tourists and don't truly understand the problems that we've been facing, and have called people like myself that have been saying, look, this is going to be a problem, saying, oh, I don't understand the new paradigm. I don't understand the fact that, we broke the business cycle. No, we didn't. You just padded numbers. Now that you need that padding, it's gone. And this is the result. So then when we start looking at Italy's 7-year bond yields, implicit interest rate on public debt, that's where we're going to see that pivot start moving higher. And that's only going to accelerate, especially as the Japanese problems get a bit worse. The two critical Eurozone economies, obviously Germany and France. Germany is having a manufacturing recession that is worse than the 2020 COVID shock. France has a service recession that's as bad as during the peak of the Eurozone debt crisis. Neither of those are good comparisons, which is why that recession is here, as that GDP growth is negative. When we look at Germany, month-on-month inflation was in line with estimates at 0.3, harmonized at 0.2, all positive, not a good thing. Retail sales, all negative at negative 1.2%. Then you look at manufacturing PMI, 39.6, worse than estimates of 39.8, huge issue. Service, slightly better, expected at 49.8, came in at 50.3, but net, you're still in a very steeper contraction. Exports were down 1.2%, but as for those that have been following us, you know what I'm about to say. Imports are the leading edge sword. And imports were expected to be up 0.5, came in at negative 0.4. Again, that is a huge issue when you look at that backdrop, and especially as we consider imports as the leading indicator, with construction still being deeply negative. Shifting over to France, when you look at CPI, came in at negative 0.5, which is a positive, expected to be at negative 0.3. But a lot of that is because consumer spending has slowed down considerably. PPI, on the other hand, had a big acceleration of 0.6. So even though consumer CPI came down in September, the August PPI is up, September PPI is up. We do see that, again, pushing that CPI back into the positive territory. Manufacturing PMI expected at 43.6, came in at 44.2. Service expected at 43.9, came in at 44.1, putting the composite at 44.1, and not a very good spot to be, with industrial production negative as well as manufacturing production. Italy, the consumer confidence came in line at 105.4. Manufacturing confidence a bit weaker at 96.4, as PPI reaccelerated again, coming in at 0.7. And as we've been saying, turning back up. When we look at CPI, CPI coming in at 1.7% and accelerating. Industrial sales weakening into the negative territory. Italy PMI expected at 45.8, came in at 46.8. Italy composite came in at 49.2 on the back of services, but services finally dipped into contraction, which is something that we've been saying, and that's why Italy, on a deteriorating basis, we see services getting worse as manufacturing doesn't really recover, which is going to make their deficit look much worse on a debt to GDP basis. French real household consumption in goods, as you can see, turning negative once again, obviously well below 2019 levels, and we see this getting worse and likely taking out the lows that we saw at the beginning of 23. On a Spanish level, CPI still positive at 0.2. CPI core, reaccelerating. Retail sales still remaining fairly strong, while Spanish manufacturing PMI beat estimates at coming in at 47.7. Services was slightly better, expected to be in contraction of 49.8, came in at 50.5, putting composite right at 50.1. So still slight expansion, while industrial output in August rolled over and is now firmly negative, which we think, again, pulls that down and, again, keeps things in contraction, especially when you think back to the new orders versus inventories that we showed across the Eurozone, showing that reduction. So, again, this is why there's nothing there that shows that we aren't already in a recession, and how it's really going to continue through Q4 and realistically well into 2024, and why we do believe on a 2024 basis, the estimated growth on global growth is still massively overestimated, and we do expect to see bigger contractions as I think companies and economists prepare for next year. So that's what we have for you on the European side. In the next segment, we're going to go deeper into Asia and kick it off with our China discussion.